selling one property and potentially you could use thousands of pounds in tax. Follow my video and let's explore this area. Hi, I'm Michael, the founder of MDH Accountants. Click subscribe and follow us to make sure that you don't miss out on all of our tips and tricks, because we help business owners with property portfolios increase their wealth and save money with tax. I'll show you 3 ways to legally reduce your capital gains tax on your property portfolio business. First of all, what is CGT? CGT is capital gains tax. Capital gains tax is where you hold an asset like a property, and that property you then sell in years to come and you make a profit. So there is an exemption for property taxes if it's your main residence for the period, where you could potentially get capital gains tax free on this property because it's been your main residence. And that's something that's well worth making sure that you're having that in the bank. But if you've got additional properties, these are likely subject to be taxable if this would be in your own personal name and or a limited company, depending on how your property portfolio is structured. And what we're finding a lot is we've got a lot of business owners that do have a mixture between the two, because it can be expensive in changing them from one entity to another. You're selling as an individual and not as a structure. So what you tend to find sometimes with accidental landlords is they'll inherit a property and it will be structured within their personal name. They'll look to build properties afterwards, and what you find is on their self-assessment it gets quite congested, where you've got income from your business, which will be salary, interest, dividends that you earn through your business, and secondly you'll get the income from your property, which will land on your self-assessment too. It's quite easy to go above 100, 150 grand when you've got all this income combined. Or if you're a business owner that's looking to just keep your income at 50, it can be quite difficult with income too, because if you're owning a property in your own personal name, you are not getting full tax relief on the interest, you are getting a 20% tax credit. So what you can sometimes find is capital gains tax is charged at your top slice of income. So whatever income you earn before, this is going to be the most amount of tax that you're going to pay on it. And if you've got property in a property portfolio, you are going to get taxed at a high rate on that, and you potentially would have lost tax relief by holding it personally, compared to something which would be a limited company, where you'd have all your properties within that company and you'll pay somewhere between 19 and 25% corporation tax. There are extra advantages, like where you can do pension payments from a limited company, which can reduce it further, but that's probably for another video and not for this session. You've never heard of Incorporation Relief. Incorporation Relief was a lot more attractive when you had a marriage value for stamp duty. It allows you to transfer your properties into a limited company, you roll over the gain, so that then sits within your limited company. You don't have any capital gain personally, and also you get to take that income from your self-assessment and leave it within your new property business. The one thing to bear in mind with this is stamp duty, because multiple dwellings relief is now gone. So you want to make sure when you're assessing this that you're also taking the impact of stamp duty for when you're transferring over properties too. Most owners don't utilise their own CGT allowance on their properties. So the CGT allowance has been a bit brutal recently. It's come down and down and down. But there's still an exemption that you're allowed to earn tax-free, so make sure that you claim it, because a lot of people don't. And also, secondly, if you've got capital gains that you've had personally and or capital losses, you can offset these losses against any gains that you've had. It's quite easy to make a loss 5, 10, 15 years ago and completely forget all about it because you want to erase it from your memory. But bear in mind, keep on top of that, because any capital losses that you've got could be offset against future gains. Saving anywhere up to sort of 28% if you're selling property, these are worth having. So make sure you are not letting these tax reliefs slip through your fingers. My mission is to help business owners exactly like you to increase their profits and ultimately their wealth. If I can help you with anything that we've discussed on this video, book in a call with me. I'd happily jump on a call, take on board any questions you have, and I promise there'll be no pushy sales pitch. But if you're looking for a self-help book and do it all yourself, there's a book that we've got that's called 75 Ways to Pay Less Tax. Click the link below, it's completely free, all of them are really good. And what tax savings can you find for your business within this? Please download it today and let us know how you get on.